What's going on, everybody? Chris here. We're going to take a look about the market. We're going to look at it from the model and see what it says. Central bank balance sheet. We'll take a look right here. Oh. So as far as like the balance sheet, looks like it's unchanged on the weekly. People have been saying there's been some steady decline. It doesn't look like it's been too much of something impactful to where it would affect things. Let's get on the right chart though, but still, like, it's been relatively unchanged. And then to see kind of the impact that it's had anytime that the balance sheet gets expanded, we could see some sort of bull run happening in the market. And the inverse is also true. It's more of just like the fragility of the market increases. This one over here is more of like it says the growth rate, and it looks like the growth rate is negative. Or I mean, it's decreasing. It's pretty much cut in half. So it's no longer as strong on the growth rate. Now, what's going on up here is more for trend. We'll get to it when we get on. That's part of the diagram. But I just wanted to show the central bank balance sheet just because it's important to see if the central bank is backstopping the market in some way. As we can see, it's unchanged, meaning they doesn't look like they are because the balance sheet hasn't expanded. Okay, we'll take a look at the events that are happening this week and then also the earnings. So as far as like the events, we'll go to the calendar and then we'll filter it. So this is already filtered. Tuesday, it doesn't look like anything big is happening. Wednesday, we got FOMC and the federal funds rate, and then also on Thursday, unemployment claims. So it's going to be really like a busy week. And then I guess we have non-farm too. So that's has to do with employment as well as the unemployment claims. So we'll see. It looks like it could be like very volatile and mixed. That's what it looks like it could be. As far as like the earnings, things noteworthy, semiconductors with advanced micro devices. And then we got Pfizer with healthcare. We got Moderna for healthcare, some tech stuff, and then some materials like gold and some more tech, Shopify and Block. And then we got Alibaba, some discretionary. And so we'll see just how things go. But not looking too, not compared to what we went through last week on earnings. These stocks are not as big. Baba might be. We can take a look at the stock market map. But as far as like those companies that we saw, most of it they've already had earnings. Like Baba is one that we saw that's relatively big. Gold is here. It's not even that big. We look at Pfizer or Moderna. They're not that big. So if we go to, so here's Pfizer. It's not as a big contributor compared to like Johnson and Johnson. If we were to take a look at like advanced micro devices, we got to find tech. Let's see if we can. Square is here. It's relatively small, and then AMD, advanced micro devices, is here. It looks like they'll have like a very small impact, if anything. But nonetheless, it makes the week look at least a little significant. Like, hey, like this has got some companies that are noteworthy that could move the market in some way based on the earnings. So we're gonna watch it, but not as big as compared to the previous week, where we had Amazon, and then we had different companies like Boeing, GE, 3M, Alpha, Google. Google is like anything of the FANG stocks that we see. Amazon, Google, Facebook, I think was last week as well. Meta, we would have to and so McDonald's, PepsiCo, Twitter, Coca-Cola. Anyway, so that's kind of just the events. We'll look at Black Swan events. Not too many. Doesn't seem like there's too many. Government stimulus doesn't look like there's any new government stimulus coming down the pipeline relating to oil stimulus or student loan forgiveness. Nothing as far as like stimulus with anything else. Nothing from the Build Back Better plan. Nothing. So we don't have to worry about that. As far as like the credit market, we'll go to credit spread alerts. 2.1, it's mixed. Something that's like escalating, high alert. Not something where we have to be super concerned, but we need to be alert with every day that goes by that it increases. It's a little tense. It's very volatile and whipsaw-like. And whenever this is up or fragile, I expect it to be showing itself through the market. And anytime when it's above 1.2, 1.4, I consider something like fragile or something that would be like a alert. So we'll continue to monitor that. And then as far as the yield curve, range here. Oh, so we want the noise. So the yield curve, we can see that through the bottom parts we have here. Yield curves, there's only two that are inverted, the 7 and 10 and 20 and 30. So not too many pieces of the yield curve are inverted. The important one, the 2 and the 10 that are already inverted, that means we have 6 to 24 months from when that inverted for a possible recession. And I don't think it's going to happen this year. But at the same time, I think there's going to be a big pullback. We'll get into that with the cycles. But with this being an election year, the conflict that's going on, the rate hikes, and how the Fed, the central bank's actually cheering the market to go down. That's what it seems like. It doesn't faze me or surprise me that we will see more downside. And we also just got a monthly market structure break. So what that means to me is that the bears are more dug in. They have a really good defensible position, and there could be more downside. And in fact, that's kind of what I'm expecting. Not that will happen, but I'm preparing myself for it and taking actions as if that were to happen in a healthy way. And then the percentage of yield curve of the yield bond treasuries inversion, it's 5.45%, so roughly 90% away from actually causing a lot of damage. So it's far away from causing a lot of damage. Once we start getting to 60% from 5%, when we move from 5 to 60%, that's when we'll be really alert that, hey, recession's around the corner. like recession is going to happen tomorrow. Right now, it's far from it. It's at 5%. The threshold is 60%, so we're 90% away from that happening. So right now, with the credit market and this, we can tell that it's still mixed. We got some inversions, but nothing new, nothing to where the short the front tail of the curve is not inverted and like say risk off. When the 2-month and 10-year are inverted, that's when it's really bad. Right now it's not that way. Okay, we'll check out the move index. We'll pull up the unique ticker. So we can see here that the move index is it closed below here. I think it was unchanged on the day, so it didn't really move. But if seeing some kind of close below, looks like a stop hunt. So it doesn't look super strong. If anything, it looks like it's going to consolidate more to where it'll retest the lows on the monthly open. So that could inspire more bullishness. So we're kind of watching for that. But right now it still looks like it's on alert, but it's still trapped to where it's in this no man's land. So we're just kind of watching it closely to see if it goes any higher. And so far, it looks like it wants to go a little lower. In the near term, that's good for us. We want that. So we're just going to continue watching that. As far as like the dollar, we want to see that on noise. Maybe it's unique tickers. Maybe it's trend. Here we go. So it does look like we've hit like a fake out zone. So it's hit the Fibonacci fake out zone, and we could expect it to come down here and this lower portion. So that could be good for the bulls of the stock market. So we're going to continue to monitor that. But for right now, it does look like we've hit like a temporary ceiling where it would be making a bull flag. And then as far as like the cycles, we're going to skip lumber to gold because we've been looking at that, and it doesn't change super fast. But with the SP500, with the cycles, we're coming up to a concave event around 5, 5, 6, 5, 7, around thereabouts. Or we could see the market start keeling over. Keeling over is like a possible turn. Like we don't know if like that's the top, but we can see that there's a possible turn that could be the top. So we have to just take very appropriate position sizing and position building rules to where we're not being irresponsible, where we're going too big too soon, because that could really mess you up. And this could be totally wrong. So it's good to just use this as like a primer of like maybe a confidence builder when we decide to go short. So something for just kind of beginning a position. So it looks like around the end of this week, we could see a possible entry short on the math cycles. And this is the decennial, which is showing like a concave around that point. The annual is saying from like 5, 6, 5, 7. And the quarterly, which is very similar. It's got a little bit of a lag, branching out all the way to 511. So I'm thinking around 5.6 to 5.11, we should see something to where it would signal a movement down. Until then, we're going to focus on some kind of long, because we just came from a convex area, a valley. So we're focusing long according to the math cycles. Close that. As far as like the money flow of the institutional buying, if we were to look at the daily, we could see on the bottom, make this window bigger. We can see that it's above the green line. So the institutions are biased to the long side. For the most part, most of the times that it's been long or above the green, we see within a couple days some kind of spike up. And then we get to see kind of how price moves. But right now it looks like the institutions are biased long, and we're going to just kind of see how that plays out. And then the sentiment is more on the bearish side. So just like an RSI that you would, if it's oversold, you would position long. This is very similar. When it's like bearish sentiment, when it's hit the red line, then you want to look for a bullish movement. And they're both kind of saying the same thing. We're long or bullish on institutional buying. We're long or bullish on the sentiment, because the sentiment's bearish. We're doing the opposite. So that's kind of what we're seeing here. And then if we were to look at a smaller time frame, look at the 4-hour. So this, with the 4-hour, you want to be a little more careful because of like the quicker judgment. It has a higher chance of being wrong. But nonetheless, we're going to take a look at what it has to say. So anytime I start to see the line cross the blue line or the yellow line, that's the Williams Accumulation Index. So that's like the accumulation of what's happening with institutions or inside buyers. Are they like accumulating a big enough position? If we start to see a divergence where the green line is going up, but the trend is down. So for the trend, I count the channel, the orange and blue line. If it's going through the green line and they're crossing each other, I call that a divergence, and I'm more likely to go bullish. So on the shorter time frame, it does look like it's indicating that. And then cross up on the MACD and the H4, it's a little more or less relevant because of just how fast the time frame is. But it's confirming a similar saying that the institutions are accumulating here. It's a bearish sentiment, so the inverse is likely to happen. It's likely to go bullish. So we're just waiting for an H4 kind of reclaim here to where we can go farther. So that's like the institutional side. I kind of want to save the adjustments I made here really quick. Oh, no, get away. Now we'll go to the technical side. So as far as like the moving averages, this is the light blue is the 200, the green is the 72 simple, 24 simple on the yellow. And it does look like they're crossing the 200. All of them are crossing down. Usually, the momentum on these moving averages lag a little bit. So, like, for example, when this 24 crossed the 200, this thing shot up on the price. But it eventually came back down because of just the momentum of the overall trend of like the lines all pointing down. And moving averages are more of a reactive versus a proactive kind of deal. So it's mainly just lagging. It's a lagging indicator of what's happening, but they make really good support and resistance. So right now it looks like really good resistance would be around this level here. But just like how this went all the way through, we could go all the way through to here, and it could respect the range better than it does the moving averages. But we do want to take note if it reclaims to the short side underneath the moving averages to see that as something significant, like it did here. It just reclaimed beneath the 24 and then also the 200, and then it made it some really good simple entries to the short side. Overall, we can say that it's all underneath all the moving averages. All the moving averages are starting to cross to the downside and get really tight. It usually means that there is no direction that people are thinking of, and that we're really choppy. The average daily range, it was extended today. As you can see down here, it extended down here and then got overextended and then started to reverse. And it was a really good point to enter. Like if we were to look at a different range, go to the H4, I drew in this range. On the previous video, I pointed out how my indicator order blocks on TradingView draws in the swing high and low to where I can put this range. Not always does it pop up when I want it to, but when it does really good. And it was when price was like right here. And then I was like, well, like somewhere around here, it could go down here, or it could totally go up here. I said that it would go up here, and I didn't say it would go down here. Either or is totally possible. I mean, I was prepared to where it would reverse here, but you just don't know until it actually happens. But yeah, with it going down, that's definitely better, and it reclaims as far as like a bullish move. I mean, they're both good. As if it were to just engulf and then come up here, go down here, and make a bull flag and continue. But right now, it looks like we've reclaimed, and it's looking more bullish. And then I'm targeting up here at 45.11, spot 41, near the fake out zone of the range. We could totally get rejected here, the 0.382 or the 0.5. But my long-term exit would be around 45.11, spot 41 on the range. So as far as like the range goes, and the average daily range, it looks like it was good for a reversal. It reversed. As far as like the macro range, we go to the 52-week range and the 2-year range. So 2-year range is on the left, 52-week on the right. We'll expand it and get some of that out of the way. It looks like we hit the 0.764 of the 52-week range, and then we're going to see what happens when we come up into this level of the 0.618. And then, so in summation, it's just saying that we're still ranging. We're still in the range. We haven't broke it just yet. But we did have some significant market structure break, which we'll get to. And it shows it right here, basically. We closed the month below 0.246. This is the 2-year range. And then now you see my level here. It looks like we could come up into it, and then the 0.13 is a fake out level. Could hit it, and then it could close below, and then continue on down. So that's what the macro range is saying to us, is that we got some levels that it's respecting, and we can choose to watch it and obey it and respect it as well, or not. But as far as like the range, we're in like a buy zone, and then with more time we could see how it reacts with the other levels. And then as far as like a last week low, we go to the daily. We just reclaimed the last week low, so that's usually seen as bullish. We went below, came back above, and now like we're retesting wherever. It looks like above here. It looks like the H4 order block hasn't been broken just yet, but could possibly be broken. So we're just going to continue to monitor that. But it does look like the H1 order block broke. I'll put this to the H1. We'll put it on the H4. Yeah, we'll just kind of watch that. Next, RSI. So with the RSI, we are oversold on the daily. So that's really good for like a reversal. So along, something going more bullish. We're expecting some kind of reversal and significant market structure break. We're expecting maybe an H4 market structure break here to really solidify, so enough basing to happen to go long, to catch some momentum. And we're really looking forward to like a daily MACD cross if we can get it, especially from stock charts right here. We're looking for this daily MACD cross to happen. But, in the fast lane, we got this H4 MACD cross, so we'll see what that gives us. But we're not 100% sure exactly how it's going to pan out. But as far as like the RSI, looking at all of them, it looks like mostly oversold. The only things that are overbought is like the smaller time frames, but we're just mainly concerned about the H4 and the daily. The H4 and the daily is what we were concerned about, and it looks like it's ripe for a reversal along to the upside. Volatility squeeze, we'll take a look at the momentum. So this is the H4 and the H1. So it does look like it's squeezing right now on the H1, and if the trend continues to go up, so we're expecting more spiking to happen. If it continues to spike up, we will see more of a squeeze to the upside. So right now, it's kind of just chilling until London Open, which is around like 1 a.m. Oh no, it's more like 3 a.m. here in Indianapolis. We go to the H4, H12. It looks like if the trend were to start moving up, this would start pinching to the upside, and then the daily and the weekly could also pinch to the upside, and also the daily. So that's why, like, I'm thinking that this could be a huge volatility squeeze to the upside for the bears, for them to take profit. And we'll see what happens. I mean, I'm speaking before it's actually taking place. Like, it's not something I've directly observed. It's something that's possible. and probable, not something that's like happening right now. But it's something to be looking out for, and that I'm anticipating, and I already got a target planned out, and we'll see how that works. But that's what we can see with the volatility squeeze. So combined with the math cycles, the institutional buying with the RSI, the volatility squeeze, it's looking pretty good. And also the market structure break. We're just waiting patiently for an H4 market structure break to happen, which it hasn't. It's been faking people out, and we're just waiting patiently for it to actually break. Trend efficiency. So we'll look at the trend. So this is what I've been looking at for trend efficiency, and the noise as well. So with this, it's basically saying it's very noisy, a lot of chop, both on the macro and the fast. Looking, it's not even inside the channel just yet, so we're just kind of whipsawing until we make that move and we close the day above, inside the channel and above the channel, and start trending. So right now, it's just saying it's really choppy. As far as like another thing to look at, instead of like the monthly and the daily, this is like the weekly and the daily, and we'll minimize that. So whenever the blue band is inside the green or the red, it's safe to say it's trending. So both the fast and the slow, it's just choppy. They're not touching either band. But if we were to see further downside, it would start trending to the downside. But we're expecting a reversal to happen, and it looks like it just might reverse to where it keeps more chop going. But we'll wait and see. It's not definitive just yet, but totally possible of continuing to chop. And that's kind of what I'm expecting with what the math cycles is telling me for right now. And as far as like the MACD momentum, we've kind of went over that already. Looks like we're going to get H4 MACD cross. We're looking for a daily, preferably a weekly cross, but it looks like it's far from it. With the daily, if we start getting a lot of movement to the upside, we could start to see it more sooner than later. So we're kind of waiting to see if this H4 cross up breaks out, and then we can see a pinch on the daily, and then maybe 2 or 3 days or maybe it'll be something like this. We cross up and cross back down. That's what I'm kind of betting on. We're going to get a cross up and then cross down come Friday, the 6th, 7th, or 8th, or 9th. I think it was like from the math cycles, the 6th to the 11th is like the window we're looking for a breakdown in the trend. But as far as like the bigger time frame, MACD, we don't have to really worry about that. But we are seeing some momentum picking up to the long side in a very small way, but it could be significant. And then a market structure break, we're looking for mostly a weekly breaker or H4 breaker. So I don't know what happened to my order blocks here. Kind of bugs me. Okay. Well, that at least we got it back. So we haven't had an H4 market structure break yet. So we're waiting until that actually happens, and most likely near London Open, we'll start to see something, if it breaks or not, or rejection. But we need this to break before we can start getting really bullish, and that would be our patient entry to the upside. As you can see, this is my break-even line, so I've been impatient, but trying to learn to be patient and not to get too ahead of myself. If I were to actually nail what I'm trying to go after, which is like one of these bottoms, I would plan it ahead of time, very small entry, and then scale into on the way up. But right now it's just too early to just start trying to buy, and then you get faked out. And that's kind of just what's happening to me, and make it publicly known, so then I become more patient over time, and then I change up my strategy of what patience looks like and what it looks like to try to attempt and get a low, and to do so in a very systematic way, and to really define patience and to be it. So that's kind of just what I'm dealing with there. And as far as other significant things, that we had a monthly market structure break, so I expected that we could see we can wick all the way up into here. So it looks like a really wide range that we can travel through, but it definitely seems like there's resistance right here. We could come up into here and get rejected here, or we could, which is totally possible. We could also close this and then do a stop hunt. And the stop hunt would roughly be, I guess, here on the daily in some way, or the H4. I think it's more of the H4, a stop hunt on the H4 on those bears, and then reverse. So it's totally possible with that. If we were to take a look at the way I'm able to determine that. So this naked pivot here is like really good signal for shorting. So usually these H4s are left alone. If they become naked pivots, they can last for months to weeks, or days. So we're just kind of expecting maybe reaching the other end of this range and then coming back to stop it out, and then maybe this becomes resistance, and then we come down here, maybe get rejected here, and then continue on down. So that's totally possible, but you could see that these are targets to the downside, and the Holy Grail would be if we got all the way down to 3,400 roughly, or the previous Corona nuke high before we went down. So it's totally possible. We'll see. As far as recession wise, I think if we were to go in a recession, we could reach all the way down here, 2,700, or even the Corona nuke low. That could be argued as a possible point that it would go to. But for now, I'm betting 3,400 because of that monthly market structure break. I just think it's totally possible. They've only done one rate hike. Imagine if they actually completed it all. What's possible. And I think they're literally cheering for the market to go down, so then they could suppress demand and get things more on track. So then things could get back to normal, or the growth. They can slow down the stagflation, or whatever it is, the lack of growth. I don't know. But those are my targets. And then how I pick this upper one is I use the 1 hour for the faster. Same principle. Look for a naked pivot, one that's not touched, which is this one. And if I were to draw a box like I do, I can't draw a box on that one, so there's no wick. So that's kind of just what I'm targeting on that upside. This was a naked H1 naked pivot that it went through. And then, so that's the target I'm shooting for in the faster time frame. It looks like all these got filled right here. The next one is like here. There's two of them up here. It's that one. That one. So whether we can reach this high, I'm not 100% sure. We'll sync it to like all the higher time frame charts. And we'll see just kind of where it's at. But it looks like, I mean, it maybe near the end in the Q4, maybe we come up into here and then we reverse. But right now, I think it's too early to assume that we could reach all the way up here. Just based on the math cycle, if we close the week above here, maybe I think we could reach here. But until we see where the week closes with that math cycle, if we close here and it's a lower high or in the fake out zone, then I'm more likely to think that we'll roll over and make a new low. Bust through here, this will become resistance, touch here, and then bust through there, that will become resistance, go down to 3,400. Bottom out, reclaim, go on up through July into September, October, November, past the election. So that's kind of just what I'm thinking as far as like what I see with the naked pivots, with the range, the context of everything, the weakness in like the credit market, and like the rate hiking environment and what it can do. And just with the monthly market structure break, just makes it even more of something that makes it harder and harder to become bullish, because the last time we had a monthly market structure break was when we busted to the Corona nuke low. And we could go here, put in this to 5. And then you could see that the Corona nuke broke it to the downside, but it also broke it to the upside. But past times that we busted through a monthly breaker is when we made new highs or new lows. And this one could push us all the way down to where we think it's going to go, which is that weekly breaker. So if we were going on the weekly breaker is right here with the gap. So roughly there, around 3,400. Touch that, maybe the order block. Yeah, right there, around 3,400. Totally possible. Reaches the other side of this, comes back up, reclaims, makes a new high into the next year. That's kind of just how I see that playing out, where we touch the bottom, going into the end of the year, into the next year. Maybe we form a topping pattern, just like this, where this is the left shoulder, but instead this in this picture, this is the left shoulder. And then let's picture that we're here, and then going into July, we're here. And then going into November, December, we'll end up here in a kind of example-like way. And then going into next year, maybe we top out in some way into 2023, 2024. And then maybe this is 2024 around here. And then we break down. Totally possible. I mean, we got 6 to 24 months from when the 2 and the 10 year inverted. So I'm expecting something like that. But we have 24, 23 months for that to play out. So that means that we're going to see some bullish movement, and then we're going to see some bearish movement, and then some bullish movement and some bearish movement. So we just gotta keep track of the market structure and then go from there, and just where the closes on the week are, where the closes, what kind of market structure breaks. Right now, it's just signaling with the monthly market structure break that it just wants to go lower. And unfortunately, 3,400, you saw where that naked pivot is. I mean, the last naked pivot was right here, and it filled it. And then now it made a new one. So it's highly likely it's going to want to come back to it and revisit it. And we got one here, and then we got one there, which is where that weekly gap is. But then we also got one down here, but for something that is going to make a new higher high, it doesn't make sense that it would go below here. You know, for this to hold on like a quarterly time frame would be really bullish, and we would want to see that. But and also like the multiple PE ratio of the SP 500 would be more balanced. It would be more on sale. On the S&P 500 PE ratio, we're at 21, with an average and median around 15. So it's overbought. It's like it's too expensive. We see a drop in price all the way down to 3,400. That'll be a different story. It might be a more fair price. It might be cheap. But the thing is, no one's really ready for that. And no one's really preparing money set aside for that kind of event. Usually people are just dollar cost averaging, and then by the time that event actually happens, there's no real money available. Instead, they're kind of draining their savings because things are kind of falling apart, and maybe they took a vacation extra that sopped up some funds, or an emergency happened. But knowing this, we can be prepared for a possible dip to 3,400 in the S&P 500, and then also a big dip all the way to possibly the Corona nuke low for the recession within 23 months or less from the last 2 and 10 year inversion. So that's pretty much it. As far as like something we're kind of questioning is like, get rid of this. I guess we'll get rid of the whole thing. Kind of just like click on that and it get deleted. Cool. So that did that. So we're just going to delete all of that. We're just going to use the words on this one. The question I'm wondering is, are we in a bull run with Bitcoin? So that's kind of like a big question. Like there's some times in Bitcoin's history that it's decoupled. and then it starts to run off and make new highs. So I'm going to try and do some analysis and figure out like what would be the levels, how would I determine if we're bullish. And I need to figure this out because my account is denominated in bits. So like any reward I get is paid in Bitcoin. So if I were to expect it to go down further, I would kind of want to get out and just rebuy lower. And then I'll just have more Bitcoin holdings. So for something like this, I think we gotta go monthly right here. Get rid of cool. Put in the gap. Get rid of the filled ones. Let's see. So there's the trend lines and there's the rectangles. Does it say filled anywhere? Filled and unfilled. Okay. And there's ones on the bottom. But, so we got one unfilled here that's possible that we can reach. And with this running over the weekend, I don't know how much to trust in this data feed, but so far, as like a quick general rule, if we don't close a week above that, I can't expect it to be bullish. And then I'll be watching a possible cross up on the MACD if we get it, and then a possible cross down. I think I'm going to pay attention more to these crosses on the weekly MACD 31016 than the actual market structure break, because I don't think the feed's really going through really well to where it's on the right candle. It might be, but it does look like it's holding. It looks like it's at support. It looks like if it touched the last week low, it reclaimed. And if it's following the SP500, we could see a spike. But I would need to see an increasing evidence that we close the weekly above here, above 50,000 roughly. And then we need to close a week above this gap here. So these are the two reclaims I want to see. A reclaim or a close on the weekly above 51,712.88, and then a reclaim or a weekly close above 62,000. As far as right now, like what I buy and leverage, I honestly, it doesn't look super clear to me, and just based on the smaller time frames like the H4, it just looks super choppy. And I would be scared to hold over the weekend. I don't know, that's just me. It's just kind of hard to predict. Ever since like we kind of got knocked out of the trend for the bull run into more of a choppy era, consolidation, it just seems harder and harder to really get a good entry until we see a significant break. If we go to the daily breaker, these daily breakers have been chopped up, so it seems like less efficient as far as like a reason to get in. multiple tests of both the bottom and the top right here. So it just makes me really leery to want to try and trade this. But if we got a weekly close above 51,712.88 or 62,278, maybe. But that's kind of my thoughts on that. But I'll be looking for those strong weekly MACD pushes and seeing how it closes on the week. And then I already gave you kind of my thoughts as far as like beginning to dip my toe into trading leveraged. But for right now, because they're hiking rates, the credit market's mixed, I'm not really liking it. So that's my thoughts. As far as oil, we could take a look at oil, but I didn't see anything super convincing. Okay, this has got the oh man. Let's turn off the channels. It just looks terrible. Okay, so I drew in a micro range with the macro, and it almost looks like there's too many lines. But so far, it doesn't look too good. It's like a huge symmetrical triangle in some way, and it could be bullish. I would want to see a strong close and a retest of the 0.382, have the 0.382 hold. If we were to look here to the left, there's this red line here. The longer we stay below that, the more closes that we have below that, the more I don't want to touch it, because it looks like it's more likely to go down. But if we get any closes above here, retest, resumption, it looks like it's very appealing to want to go long, because this has, I think, 66% to the upside. Let's see. Yeah, that's where the fake outline is. Oh, more like 30%. But once we hit the Corona nuke low, or not the Corona nuke low, that low in July, according to the math cycles, if we do hit a low, that could turn from 30 to 60%. So say we hit the bottom of this channel or near the yearly open, we reach all the way to here. It's like an 80%. It's an 80%er. So that would be something I would be really excited to trade after we hit a low, just because I just feel more confident. It would be more of a swing failure pattern. We already got the levels lined out. This would be the reclaim area. This would be more of like a fake out right here, but reclaim right here. Any reclaim above the 382 would be definitely good entries to the upside. But yeah, like it looks like we're below this blue line here and this pink line. It looks more bearish than bullish. We could see a spike into the 0.382 right here, get rejected, or maybe up here, or right here, get rejected, come back under, and reclaim to the downside. We'll see. Oil doesn't look super appealing to me, and it looks very choppy. But when it does hit that bottom, and we got some positive momentum to the upside, looks really good for a long to make an 80% gain on oil. We got the virus subsiding, and once we hit 2023, going into the summer, looking really good to hit really high. Right now with the rate hikes, it does look like it could squash demand for oil as well because of the rate hikes. But once we get into the election year's over, the rate hikes are done, it looks like it could pick up really fast going into the next year. I mean, it just looks bullish going to Q4. So that's kind of just what I think about oil, thoughts on Bitcoin, and S&P 500.